down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Hey. Oh, education is the number one thing, I think, for success. A lot of people don't understand the more you know, the more you make. And, or in this case, the more you know, the less you pay in taxes. I got to give a quick shout out on the show today. You tuned into the Savvy Radio Show. Hey. Rose Taylor, welcome to the show. I see you all the time. We're partners. And so I got to do this introduction. But before we get started in who Rose Taylor is, if you don't know who she is, you can search her. You can search in the episodes to find her. There's a lot of great content and episodes with this amazing accountant that I have on the show today. But let me just quickly, if you listen to the last podcast, my tax burden was $187,000, and Miss Tax Superstar here in front of me said, Stephen, if you didn't do cost seg, which was her suggestion, and she's been suggesting it for a long time, but I was a dumb, ignorant investor that thought $6,000 was a lot of money, which turned into saving me $100,000, and then hey, if you did cost seg again, it brought that tax burden from $187 to $80 down to $6,000. So I think it's with your guidance, Rose, that I am successful. Not think, I know. So I just want to shout out to you for that. I gave a shout out to Crystal Carruthers and Russell Hunt for encouraging me and helping me and holding my hand through the cost seg. This is what's interesting about you as an accountant. You just say, go do it. And then I'm like, I don't know what I'm doing like today on financial statements. And so that's why you're on the show today.
Well, thank you. I do want to say, because a lot of times you make blanket statements like, okay, I'm not calling you out, but I will in this one moment.
Here we go.
Cost seg is not for everybody. So just make sure you're strategic about it. A $6,000 cost, if it's not saving you more than that in taxes, then it doesn't make sense. So in your case, yes, you had $1 million buildings that it absolutely made sense because it broke out all those different structural components.
See, this is what makes you so good. You're right. If it's $250,000 or less, it may not be advantageous for you.
I don't know. I mean, everyone's tax situation is different. And also your building has to be available for rent. So... Oh, there's a lot of, I didn't know that either. So again, be strategic and talk to your accountant. It's just like with many, many situations, it's not a one size fits all answer.
Okay, good. So my guy that was on the show on the Advanced Investor Alliance, he'll do a free report for you. Mm-hmm. So there's two caveats I want to say there. First of all, if someone's charging you $500 to do a cost segregation, it may not be 100% accurate and for an audit. So keep that in mind. And then you should pull the trigger and find, not maybe pay, but at least have that dialect. Should I call the cost seg guy first? That's what I did. And I delivered it to you. And then you gave me the thumbs up. Mm-hmm. But the also problem was we were waiting on the cost seg and you couldn't do the taxes. You're like, hey, dude, I'm waiting on you now.
Yeah.
So those are two things that I learned. One, get the cost seg rolling, at least a preliminary, kind of like they'll do a free report, but then get it to your accountant and have that, because what income tax bracket you're in. So it's a good point there.
Yeah. Is the $500 ones like the DIY ones? Because I know there's websites out there where you DIY it
yourself.
And I mean, I wouldn't be confident enough to do that.
Especially when you have 50 units and you've been running that property for 10 years and you're like, oh yeah, cost seg, I heard it on the Savvy Radio Show. And you go back. We know people that have tried to do that, and it may not be the smartest move to amend your taxes because you can't go back. Or can you? You
can file tax forms to correct it, but it's a change of accounting method, and there's a lot of paperwork and steps involved.
So the changing of the accounting method, is that like from GAAP accounting to just cash accounting, accrual accounting? It's changing
your depreciation.
So you have to do an equation of what you've already debited.
And then there's forms your tax accountant has to fill out and to be able to do that.
Justification.
Mm-hmm. It's not simple.
All right, just before we get rolling here, is it true that the government kind of encourages you to do cost segregation? It's like law somewhere. I've heard that somehow, like it's on the books, but no one actually does true cost segregation. They just roll with it. Have you ever heard anyone talk about that?
I haven't heard specifically that they encourage you, but
And it's not mandatory.
No, depreciation is mandatory, but accelerated depreciation is a bonus for business owners. And that's all the cost segregation studies are doing, is accelerating certain pieces of your building.
And when you said accelerated, that's because of like the political climate that the president makes that decision. Because I know Trump accelerated it 100%.
Right. And that's Congress. So, now it's down to like 80%. But those things change every year. Accelerated meaning that when you buy a commercial building, it's depreciated over 39 years.
Okay.
So instead of taking that $1.1 million asset and depreciating it by 39 years, you're splitting up pieces of it and saying, okay, this electrical piece is going to be over 15 years.
Versus the true 30. So you're accelerating it. You're getting that electrical item itemized now.
Exactly.
Okay, so I can take the deduction now.
Exactly. And you're, you did make a good point on your last episode that you said, I may have to recapture that. And that's absolutely true.
Right. We're not going to get into that one right now. But, and that leads into another scenario where I know a lot of gentlemen are at this level of $3 to $6 million acquisitions to kind of mitigate their tax burden, which are just kicking the can down the line.
Yeah.
And you're in a slow market as we are today. I'm not buying an asset that big. I'm going to have to, but my income hasn't changed.
Right.
So that tax burden is going to be there.
Yeah. So it's always just thinking about what's the end game, your long-term goals. If you want that to be a legacy property where you hold on to it forever, that absolutely makes sense.
Right. And you can also, could you take a loss too? If you ever came into a situation where you took that depreciation and you gained $100,000 off your taxes, not gained, but it eliminated that part, and then you took a loss on that property, do you still have to carry back that? You do? Yeah,
because now your basis in it is essentially your purchase price less depreciation already taken.
So it's a negative. Okay. Well, this is not the cost segregation episode. This turned into...
and one thing is I think there's a misconception that your accountant does the cost segregation study.
True. That is a misconception.
Okay, so there are firms like, Big Four firms that actually have people on their team that do cost seg studies, but most...
Is it an independent thing? Because they have to have an engineering license, is my understanding.
Okay. But most small accounting firms don't do them.
Okay. So yes, I think you should keep it separate, like quality of service, right? If they're an excellent accountant that studies real estate taxes, do you really think they're going to be out there knowing the proper engineering? Like what I've heard is like the hinges on the door.
Right.
I mean, I know there's software and boilerplates, but reality is like the hinges.
Yeah.
Like people cost seg on a hinge.
Interesting, just looking at your couple reports, all the different components that they broke down in detail too.
Doorknob,
Could you imagine your
cabinets?
Can you imagine your accountant out there with a hard hat?
Yeah, and that's another thing too. A lot of these $500 ones, they just kind of just guesstimate or have an understanding that every 3-bedroom, 2-bath, or whatever the case may be. I just think you're opening yourself up for a liability. You're doing it yourself. You have no insurance. There is errors and omissions when you hire. And this individual has a license that I've used.
Yeah.
I would be interesting to find out if that's necessary. Anyway, back to financial statements. I know that a lot of the people that I work with, aka clients, students that I coach, and in the accounting firm, you deal with a lot of entrepreneurs that don't know balance sheets, don't know income statements, and for sure never even heard the word financial statements. And they're all one, right? They're all together.
Right.
I think we, as especially real estate investors, we just think financial statement is to get more money. Like, I need to do my financial statement so John Day will loan me more money. I'd throw his name out there. He doesn't listen to this, but I'm just saying that just seems like I got to update. And, you've clarified that to me already. There's a balance sheet, and then there's a profit and loss. And then you said earlier off camera here, you said that the income statement is the same as a profit and loss.
Yeah.
So then why do people call it two different things?
I don't know. Maybe there might be a formal answer for that.
Right, we're going right down.
This is so funny. Early on in my career, I reported to the CFO, and he did something, and you have to keep in mind that my degree was not in accounting. I just started. Yes, you did.
I know you went to OU.
So I just started in the accounting department, and one time he asked me for a P&L, and I'm like, what is that? Like,
because income statement is also known as a P&L.
But look at this report here. It says profit and loss.
So just to clarify, that's the first thing you've learned. Pull your car over, take notes. Profit, what is it? Balance. What did we call this damn thing? Income statement is a profit and loss. It's just confusion, and that's why, I don't know if you knew this, Rose, but I have, fun fact, I've taken accounting 101 like 3 times in 3 different colleges, and every time I drop out for this bullshit. It's
textbook accounting is not fun.
It's just, I swear, I'll get all amped up. I need to master this. I need to learn this. And I get in there and I'm like, okay, like the 5th day, these things have to balance. And why? Like they're not balancing because they're in different brackets and there's certain rules you have to memorize. And if you don't use them every day,
and then you get into cash versus accrual and
then gap accounting or
managerial accounting.
Well, I learned that the hard way. That was one thing I want to bring up too. A lot of people I know for a fact don't know this, and if you know this, you're a smart guy or gal. Managerial accounting is inside your business. Only you and your internal team and maybe your accountant, depending on who you interact with, if that accountant is on your team. But that's kind of where you kind of see things and then you get them. In my case, I use Buildium. I use my own kind of spreadsheets, and then I get them into QuickBooks. Or in this case, I give them to my bookkeeper. Right. Then my bookkeeper creates these documents that I think are critical to run your business. Right.
And a lot of times for business owners, that's kind of where it ends. Like
they just do managerial.
Well, no, they get this every month from their accountant. And then they're like, okay, well, that's great. What do I do with it?
Well, that's why we're here today. We're here to read this.
But then that's where, the accounting world has so many different areas. And, not one person is an expert in all of them, right?
Sure.
So when you hire an outsourced accounting, they're doing your bookkeeping, which is putting the data into a format like this so they can prepare the taxes.
And so the ideal goal is to do it every month.
Yeah.
So the tax preparer. So there's 2 different entities or 2 different hands on the situation here.
Yeah, and then I'm going to talk about a third, which is more CFO type.
Okay.
And that's the management of the accounting. Okay, what do we do with this? So a lot of small companies, big companies have internal CFOs.
Okay.
And those are the ones that they may not be putting this data together, but they're the ones each month saying, okay, well, why is our labor X percentage? Why is our cost of goods so much?
That's the CFO.
We need to go do time labor studies. What's going on? And analyzing the numbers and then sending that to the president so that he can make informed decisions.
If we need to increase labor or decrease our marketing or whatever the case may be to hit the benchmarks
or the KPIs,
for that entity at that moment.
Since, as small business owners, a lot of people don't have the in-house CFO, so they themselves have to kind of dial in on what their goals are and how can I make sense of these numbers.
And I think a lot of entrepreneurs don't even look into them because they don't know what they're looking into and they're insecure about them. But I think it's a train wreck.
Yeah.
And that's why we're here today. So get us a broad stroke. Which document would you, so my accountant drops this on my desk. On my desk right now, I have a profit and loss, AKA income statement. And then I have a balance sheet. But this balance sheet says income tax basis. Is that something that's different?
No, that's just a heading format.
Okay. So you as a entrepreneur yourself and that you prepared these documents, which one should the investor entrepreneur look at first?
I think investors always need to look at a balance sheet first.
And that's the real time of what's going on in your business.
Well, the problem is, and we see a lot of business plans come across our desk all the time, or people that want to sell their business, or the vice versa. Someone's like, hey, I want to buy this business. What do you think of these numbers?
Right.
And 9 times out of 10, all I see is a P&L.
And the balance sheet is like the real assets, like what the company is truly worth at that specific moment. If they're carrying on debt,
exactly,
it's big and blazing.
Yeah, it's the company health. It says, here's my assets and here's all my liabilities.
Okay. And those assets would they be classified as the same as your assets on your personal financial statement?
They could be if they're in the same business. So
okay. So globally is your personal financial statement means all of your endeavors. This specific financial document, the balance sheet, is specific to that business.
To that entity, yeah.
And if you have multiple big office buildings, you would have multiple big balance sheets.
If you set up those all in separate entities.
Well, you should for liability purposes, for insurance purposes, and that's another episode. Okay. So now the first thing that as an entrepreneur, so now all you guys out there, gals, you're looking at it. Okay, the first line is assets. And it says current assets. Is there ever another difference between not a current asset?
Like long-term assets.
Okay. So what's the difference between a current and a long-term?
Current is usually like less than a year.
Okay.
Or cash, because that's obviously current.
And liquid.
Liquid.
So it means also current could mean it could liquidate too.
Yeah.
No, not liquidate, but okay. So then we have a bank account on here, just one bank account. Now, if you had multiple bank accounts for that.
Yeah.
But
all of them should be listed there.
So how does this correspond with someone that has multiple entities? Would a tax preparer have a balance sheet for all those listed on there?
They should.
They could tie all those together. Because right now we're just looking at one entity.
Yeah, this is one. We're trying to keep it simple. One entity. Yeah.
Okay, because like I know on my personal financial statement, it lists several bank accounts, but those are different companies and different entities.
Yeah, because again, think of it as a personal financial statement is for your bank,
and
for
global,
you personally,
and global.
Yeah.
Not in managerial.
No,
because it's not dialed in.
Right,
it's just a big picture.
One business. Now, if this business had multiple stores, let's say like I don't know, a restaurant.
Okay.
And you had multiple stores that rolled up into the same entity, those could all be listed on the same balance sheet.
With 3 different bank accounts.
Exactly.
So you can manage the POS on each store that registers together. That bank account goes with that POS. Okay.
Yep.
So this is a very clean financial statement because it has no assets. It has no assets. We're looking at, so I know this is difficult and we're going to have a class on this coming up. This episode is just to get you the ball rolling, but let me get to the point of when there's our class. It's on October 24th. So exactly 2 months away, you can get used to understanding this type of language. You need to learn this language. The goal for the class, October 24th, is to evaluate your own financial statements. So you should bring your own, how to create them and prepare them and understand them so you can have a proper conversation with someone.
Yeah. And what you look at, or for example, what I look at may be different than what you look at because it's different industries.
Okay. So just now I'm going to start asking dumb questions. Now, they're not dumb to me,
right.
And you don't know if I know the answer or not. Okay. So we're just going to play. Okay. So I'm looking at this assets and it says I have $60,000 in this fake balance sheet. Now, is that all current income for that? That's on the other page. This is a carryover. So we're saying I see on the top of this financial
balance sheet should be real time to the date.
Right. So it says July 31st, but where did this $60,000 come from?
That's accumulated. It's historical money.
So like next month, it may be 70 if I don't do a distribution, if I don't hire a new employee.
You don't have operating expenses. If you have
this is a carryover.
Yeah,
real money.
It is real money, and it should be reconciled every month to your actual bank statement.
Well, I hope.
Well, because banks make mistakes too.
Well, also it throws it off if you made a transaction on the 30th of the month.
Yeah,
and it doesn't post.
This will also it may not always match exactly to your bank account if you have outstanding checks.
Right, and then you can see what your liability is.
This is important for people that do what I call checkbook accounting, where they look at their bank balance and they say, okay, I got enough money.
Until
but you may forgot about that $1,500 check you wrote last month.
Which is even more weirder. I had to pay someone and I had to actually write an address on the envelope. And I was like, is this possible? Is this going to get there?
Yeah, so this balance represents what you have, including checks that you've written, even if they haven't cleared.
Right, because it hasn't posted.
Right.
And this is only July 31st, and now we're in August 24th, so It's impossible. So
it could be more, it could be less.
We could have spent $60,000 on a Hawaiian vacation.
on August 15th.
Right. Okay. So it shows me this. So, but do you ever look at every month, like print these out from January? I know there's sheets that I've seen that have done year to end that has the columns.
I mean, yes, you can look at a balance sheet month to month. I usually look at it from the prior month or the prior 3 months,
right?
Just to kind of see what's changed.
Now, if I was purchasing a business, would I want to see all of these every month and see if there's any kind of patterns or anything that's like kind of unusual? Like, why did the revenue go down to 12,000 that month, and then the 1 month it was 20,000? That's a 8,000. That's a 40% drop.
Yeah, and that's kind of what CFOs do. You know, when they're being audited, they put the notes in there of why did this change? Okay, well, we had shortages from our manufacturer. We had to buy from this local company that will cost more money. Okay,
on this balance sheet, let's say I bought bags for my business and I have 5,000 bags. I only use 1,000 bags. That would be considered inventory, not necessarily an asset.
Well, inventory is an asset, so it would be considered.
But it would be on here? Mm-hmm. So it would carry over. Okay.
Yeah.
See, there's the okay. So then it says other current assets, credit card receivables. So, and I see someone hand wrote a negative sign in there.
Well, no, that was not a negative sign. That was me pointing it out. So I sent it to my bookkeeper.
Okay. So this means that this hasn't been posted or reconciled.
It means that a client has paid with a credit card and it rejected.
Oh. Because it's receivable, because we're waiting on it.
Yes.
And then we have so this would be a landlord would have, so this is on August 31st. Some people prepaid and some people haven't paid. And that's what this could have.
Or it was payments from the past that
still haven't paid.
But again, that's why I sent it, because if they, let's say, everyone's business is different, but let's say a payment rejected and they paid another way, like maybe cash or through an invoice or something like that, that would show up differently. And so that's why I highlighted that to send it to the bookkeeper to be like, look into these transactions and are they really true?
Well, and also for me, I'd be like, where's our money?
Well, exactly. And that's, me as a business owner, I see that too. But that's why you as also, all of you business owners should look at your financial statements, because you may see stuff like that.
So technically, if I was just in a hurry and it says total assets on this line, so we had the assets, it broke it down, bank accounts, the specific bank account, other current assets was blank, and then it says the receivables and then undeposited funds. Hopefully that is in somebody's drawer somewhere
vault.
or it could be cash. Okay.
Right.
Now this number says 67,000. So we went from 60,000 to 67, but we don't know for sure because we have to verify this receivable.
Right.
So this would be a trigger for you. Okay.
Yeah.
So then we go down to the liabilities and equity. Liabilities, obviously, these would be loans, or in this case, this individual has a credit card out and it has a credit card name on there, and it says they have a $7,000 balance that's a liability because it's due.
Right.
Assets make you money, liability costs you money. And then it has other current liabilities. These are things that are carrying over. So you have payroll.
Current liabilities are things that are paid every
month.
Yeah, like regularly.
So would it be utilities?
No, it would be mostly it's payroll, like the taxes.
But don't you pay utilities every month or rent every month?
Yeah, but they just get expensed.
Oh, this is a balance sheet. Not.
So this is a liability, meaning that when you.
This is due.
It's due.
Okay.
Yeah.
So let's so expenses versus a liability. Can you define those? There's muddied right there. We just muddied the water.
Okay, so let's say that you were doing accrual. Now we do cash accounting, so
which is my favorite. Most
it's
businesses,
easier,
yes.
But we also
money in, money out.
We also deal with a lot of businesses that do accrual.
Okay.
So when they get a bill, let's say for your utility, they post that as a bill.
Oh, it's liability.
It's a liability, yeah.
And then it washes out, balances out, or reconciles out when it's paid.
When it's paid, then it becomes an expense.
But we're getting into complication if it was a manufacturing company, correct?
No, it'd be the same.
But it would be weird on that month.
Yeah. I mean, a lot of businesses don't do accounting that way when they're small businesses. You just, like, I'm not going to post a $57 utility bill when I'm going to pay it every month anyway.
Oh, because it's just labor.
Yeah.
And it's expense somewhere.
But if you were, let me think of another, like a construction company, for example, or flipping houses, you don't want to have a clear desk policy. You want to pay your bills when they're due, not when you get them. Okay. So if you have a vendor that gives you 30-day terms, you might, so you don't forget about it, post it as a bill. And then when you do your
so now we're talking about bookkeeping.
We're talking about AP, which is accounts payable. Right. And when you go through and pay your bills once a month, you're going to have a whole list of all these bills and their due dates.
Okay, so now that makes sense. So that's why bigger companies have just AP people.
Yes. And then AP apartments, AR apartments.
And then they have receivables. Mm-hmm. And they're two different people. Is that for accountability?
Usually two different people. Because it's two different skill sets.
Accounts payable, you're just posting bills.
And paying them.
And paying is more of a risk.
And working with the CFO of, do we want to pay these bills? Because...
Or on-time cash flow.
Exactly. It's all about cash flow.
Should we wait? I never want to have that feeling.
I know, but, I've worked in large corporations that...
Like their food bill's $1 million.
It's strategic on when bills are paid. Even if you have 30-day terms, okay, we're going to work with this vendor and we're going to try to get 90-day terms.
Because of interest that you're paying on the loan.
Yeah. It's fascinating.
And that's business where there's a line of credit involved. Mm-hmm. And if you're paying these bills for an extra 2 months that you don't need to, you've just paid interest on something that you didn't have to. Mm-hmm. And so right there just pays for the accountant in itself.
Yeah. And then the AR is the collections one. That's, the one that you got to, they have they drop the hammer and they are not afraid to.
Okay. All right. We'll keep on rolling. I know we're on a time crunch here. So then this payroll liabilities, you have this federal taxes. So you're just pulling these liabilities out now for the end of the year. This is going to special account, or do you pay?
Those are paid every month. Usually whenever your pay cycle is.
Okay. So then the current liabilities for that, because of the credit card and the federal taxes, your payroll, the total liability on this document says $7,000. So there we go. And then you have, there's distributions on here or equity.
Yep.
And so why is there negative numbers on here?
So the negative numbers represent your draws.
Okay. So this is how much it was been paid out to those two partners.
For the year.
Okay. And then this actually shows a thing called retained earnings. And this would be, if you had a partnership, this would be split?
Yeah. Yeah. On your K1, it's part of your basis. Yeah.
Okay. How does retained earnings work?
So think of retained earnings as a historical number.
Fake number?
No, historical.
Okay, it's an old number.
It's the profits your company has had since its inception.
Okay.
After you've paid yourself out.
So in this case, the retained earnings says $38,000. Is that from the conception of the business? Mm-hmm. Now, this is money that's owed to the owners that are tax deferred because they've earned it already and have already paid tax on it and left it into the business.
Correct.
And then that goes to all entity structures, S Corp, C Corp? Mm-hmm. Okay. So you as an accountant, okay, so now we're down to, it says net income thus far since July, the business has produced $122,000.
Yeah, and so your net income number should always tie to your P&L number, your income statement number.
On the other page.
Yeah, as long as you're running them for the same month and you double check it because...
Okay. So there's a little tip here. So I have these two documents. One says balance sheet, one says P&L. Now, my net income needs to match that number, and it's off by like $40.
Look at the very bottom.
It's dead on match. Okay, so we're going to go over the profit and loss here in a second. So in this case, these two partners receive this amount of money throughout the year. Mm-hmm. So how do I factor in what the net profit is per month? Now, if I ran this equation myself, I would divide 122,000 by the 7 months.
But months fluctuate. So
because of receivables.
Yeah. And the other thing to note is like when this year is over, your net income will roll into retained earnings because that's your profit for the year.
But you've taken this out because of distributions.
No, this at the end of the year, let's assume that we don't take any distributions. This number will become part of retained earnings.
Oh, if it was left over in December.
To become the historical profit. And it will roll over into 2024.
So we're still rolling over this amount. Is this a safe? So how does someone determine what's a safe number for them to continue to keep into the bank account? This basically what this question is coming from is like, Steven, this is a question I get a lot. I have 20 properties. My debt service is 10,000 or whatever. Okay. How much money should I keep in there? Like a rule of thumb.
Right.
So back in the day, it used to be 6 months. I would say a year now because of this interest rate BS. But I'm just
right.
How do you determine that? Is there a way to determine that? And is that a CFO thing?
I think that would be a CFO thing and also a personal thing too. Like, what's your risk tolerance?
Right. So is this a number that this company carries over all the time? Mm-hmm. Okay. And then these owners decide on what that number, if they want to ride red. Yeah. But
technically, if you're riding red, there's no money to take distributions.
Right.
And this is where, I've seen companies get in trouble before is they are taking more distributions than the company is profitable.
Yep. That's my next question.
That's a whole other thing.
So then I would say if your total payroll, how do you know what your total payroll is per month? That would be the next sheet.
Right.
That profit and loss.
That would be on your P&L.
So then on my P&L, the next paper, I would figure out what my monthly payroll is. Like in my case, in my, real estate empire, let's just say it's $7,000 a month. So I know that I have 5 months. And in this case, I would have almost 8 months of breathability.
Yeah, think about your fixed costs. Like, what do you absolutely need to run the business?
Mortgages, utilities.
Yeah. Okay, so you know that you need X amount every month to cover your...
10,000, let's say.
Exactly, your fixed expenses. Now, what can you earn above that? And do you want to continue to reinvest it in your company, or do you just want to pay yourselves?
But when people reinvest, they're not paying tax on it, correct?
Because it becomes an expense to the business. So let's say, we want to...
buy another billboard.
We want to go hard at an expo or something, a big one.
Right. And pay all those costs.
Hopefully
to get more business.
Exactly. That's the point. When you're reinvesting in your business, it's either...
Not to buy t-shirts.
The goal is to get more money, right?
Yeah.
And sometimes it's a risk.
You're slapping me around. One thing I learned as a DJ, when I was on a DJ company, I would print shirts up. And I would spend $500 running around giving away shirts. And then I was like, it made everybody feel cool, but was it tangible?
Right.
It was an expense. But then I realized that was a real profit. It wasn't just the $500. It was the $1,500 of labor and work to ink out that $500 that I just basically put up on a t-shirt.
Right.
Those are just hard skills. So if you look at the business like this on a monthly basis, you can kind of get an understanding of, and when you're fighting for that number, you want that number to go up.
Right.
Okay.
And I mentioned KPIs earlier. That's different for every industry. But for me, I mentioned labor. What is that percentage of sales? What percentage of labor?
Well, that's why I enjoy this food business because it's pretty not standard. Like some restaurants, only make 2% or 10%. These numbers are all. But if you really dial in and across the board, sub sandwich shops, their profit margin's 30%. Right. So you kind of have an understanding. Again, if you have a really bad general manager and they're stealing every day, you'll be quick that 30% is not going there. I remember starting a business in the beginning and our margins were like 80%. We're like, this is and then all of a sudden that staff member didn't work out. Then you have a retention cost. I mean, then you have a loss cost of $6,000 or $8,000 because you carried them for 3 months. Now they want unemployment. And then that goes down. Then you have to factor that number. You have to go back and add that in. So, all right, so now we're on this thing called profit and loss, what everyone dreams about, the profit and loss, the P&L, aka income statement. So you have on here, you have these income and you broke it down. You have it, and in this case, you have a line on here. This is some sort of your business online sales. And then you have on here, you have referral rebates. Then you have refunds. So you have a problem with people not liking the product or service.
Yeah, or discounts or something like that.
Oh, you can't. Okay, so a refund is not necessarily okay, because that would be accrual accounting. That would not be a cash accounting. Because on accrual accounting, you would have to have the real number.
Exactly.
And then,
look at you. Yeah.
Well,
because the revenue was already claimed maybe in a prior month.
Or it was in an inventory. You had that shirt for $10 and then you sold it for $8. That would be a refund here.
Or no, it'd still be a sale.
No, but the $2 that was lost revenue.
That would be a cost. Yeah.
But it would be under the refunds.
Yeah. One thing to note is your income classes should be set up in a way that makes sense for you and what you want to see for your business.
Chart of accounts is what you're saying?
Yeah, your chart of accounts. So like some people just say rent income. Well, some people want to see rent income. They want to see late fee income. They want to see pet income.
Or by specific entity or by specific property.
It should be by specific property as well. But let's say you're in a packaging. You want to see all the different types of packaging you're selling.
What's hot, because you can make decisions.
In a restaurant, you want to see, okay, what's our subs, what's our chips, what's our desserts, what's our drink sales, all those broken out separately. Because if let's say your dessert sales are really in the tank and they're costing you a lot, it may not make sense to continue to sell desserts.
Yeah, I think that decision, studying other businesses, like too many items on the menu, you're carrying the cost. Like I've learned that, you have a warehouse space and you're storing things and it's just costing you money if it's not selling.
Exactly.
Because you could have a better new product in there or whatever. Okay. So you have several things of income in here. You have multiple ways. You have, different classes in your business. In my case, like Savvy, I have retreats, I have coaching, I have books, I have all these things. So these would all be broken down.
Yes.
And how those income generators would come in.
If it made sense to you to have them broken out. Yeah.
Well, sometimes I get lazy and just lump it all in.
Yeah. So accounting is a two-way street. If you're going to make a lump sum deposit and then a month later your accountant says, well, what was this deposit for? And you get irritated.
Well, it's interesting. I'm really quick at writing that expense and writing on that receipt, but then I'm not really documenting. I know that my bookkeeper, who's internal, is just marking as Savvy income. Right.
And that's how your accountant is marking as Savvy income.
Yeah, I know.
But if you wanted to break it down further and get more detailed.
Yeah. I mean, I have a pulse on my business because it's so small.
Right.
I know what that revenue personally. And but if you were a bigger enterprise.
Yeah. And that's why it depends on your
And you know how I do
size.
This? And you know how the real lazy way to do this? I don't know if you would recommend this at all, but I have a separate account for Savvy that I earmark for Savvy events, but that has nothing to do with my real estate. They're separate. Now, they're all under the one big umbrella, but interesting.
No, I think that makes sense. Definitely.
It's just easier for me. Don't deposit this in this account. Deposit this account because I usually run that account with expenses.
Right.
That really are justifiable to that event.
Absolutely.
Even if we were mountain biking and having a class on financial statements.
It's networking.
For networking. All right. So for the total month of revenue, this financial statement says $42,000. And then from January, this is the number I love. January to July, it shows the total gross. Now, this is gross amount.
Right.
Why doesn't it say gross on here, Rose? Well, it says it right down the bottom. My bad. Damn it.
Wait.
Trying to right there.
Says, yeah.
40. Okay. And why is it 2 lines? That's another total income and gross profit. See that?
Oh, because if you were gross profit is your income less cost of goods sold.
Okay, if this was a manufacturing business.
Or a restaurant or anything.
So this business ran on accrual accounting?
It's cash.
Okay.
But, some businesses don't have cost of goods sold.
So in this case, for a year, this has a percentage and a year to date. And I can see these percentages. One says my total income year to date is that mean it's up 13%? What are these? What's that mean on the side?
That one, don't look at that. That doesn't make sense.
Who printed these out? Freaking chump.
Well, somebody was supposed to print out something.
I know. It's supposed to. What? Never mind. All right. So we'll get into this. Referral rebate was way up by 42%. Is this typical to have this? I like those percent. What's happening here? There's percentages on the side of kind of the shifting and moving of these numbers per month or per year.
So I like to look at the percentages. Okay, what percentage of income is this certain?
Yeah, and it has negative ones on here too.
Right, and that's why I said it's because I did a year-to-date one.
Yeah. Okay.
But I like to look at, okay, what percentages of your revenue is subs? What percentage is drinks?
Okay, for the restaurant.
Or like in the cannabis side, what percentage is flour versus concentrates?
That's the question I always ask too. I'm like, what's the hot seller here? And so
it's always flour, but...
Right, but which flour?
Right, and then that's where, okay, do you break it down in intricate, or is that something your point of sale does?
Well, you answered my question. Point of sale. All right. So then I got this gross profit. This is all the money that rolled in, $42,000. And then my year to date is $323. And then I have these expenses. Marketing seems so minimal that month. It's only $40 for the year to date. It's $7,000. Interesting. So me personally, if I was looking at this financial statement for the very first time, I'm like, okay, well, I know it's 5, 6, 7 months. 7 times 40 is 200 something. Something happened, and they spent a lot of money on something, maybe a trade show that month.
So I think the income statement that's really fun to look at is the one that for the entire year, but by month.
Yeah, I would. Well, then I would go back and try to figure out, because if someone hired me, and I scrutinize people's financials all the time, even though I don't know what the hell I'm doing, I'm like, that doesn't make sense to me. Or it's easy for rents. I always ask them, how many units do you have? Okay, what do you think your average rent is? $700.
You're also able to see, red flags too. Okay, like
was it keyed in right?
In our firm, we have bookkeepers, and then we have lead accountants. And we train the lead accountants. Okay, these are all the things that you need to look at when you're reviewing a set of financials. Is if rent if it's always been there and it's not there this month, that's a red flag.
Well, theft.
We should go back to the accountant or to the client and say, hey,
where's those deposits?
Where's the rent? Did you pay your utilities this month? Was your accountant fee paid? I mean, all those your costs your fixed costs that you have every single month should always be there.
So that would be the first thing that I would circle. If someone handed me this, I'm like, why is it only $40 this month? And $7,000 for that far would make sense. That's roughly $1,000 a month in some sort of advertising. But again, it could have been an error that month. That check didn't post that time.
Yeah.
So I'd have to go back 2 or 3 months.
Or something was posted to the wrong chart of account too.
Ooh, well, that's why I'm not an accountant. All right. So bank charges, those little punks, they charge $44 only for the year. So someone has a really good account here. That's very smart. Contractors, so you have outsourcers. So now I see this $5,000 number, $40,000 for the year. This tells me that I need to get my 1099s ready, and this is not flunky. This is some serious.
Right.
So for only 7 months in, I got $120,000 probably. It's gonna. That's I don't pay you. That's at least 10 people at $10,000.
Right.
Or I might have a really good contractor, okay. Insurance, I'm paying that. Okay. Again, that number's a little off again because it says $60 for July and it's $2,500 for 7 months. Those numbers don't add up. Because I always amp it, over here, I'm dividing it the whole time.
And this is what, CFOs would do too. Okay. Well, what
happened?
What happened?
Why is, because insurance is a lump sum.
What's the explanation here?
Right, or it could be zero, and I just saw $2,500. Okay, we wrote that check in January.
Exactly.
So why is there a $60 carryover?
Right.
It's minimal, but it needs to be addressed. The internet is bullshit expensive, but not reasonable. Again, we have another problem there. It says year to date from January to July, $333 for for internet, and now we're paying only $170 for this month. Again, where is that going? The meals. $475 in July. This person is partying it up like a rock star. Office supplies, okay, seems legitimate. That office supplies and software could be your IT person. So I see that why is that $21,000? And I understand that this business has these key things that they have to pay for. Now you got this company payroll expenses, which seems less to me, but that must be their federal because it's so low. It's only $21,000, $2,000 a month.
That's the supplies, I think.
Oh, the supplies. So, no, we're breaking it down here. So then why is there negatives on here? It says payroll, company contributions. It's a negative number.
Because it looks like they have not paid their insurance premium that month.
Okay.
So that would be, so they withheld insurance from their employees, but they didn't book the expense that month. So that's why it's important to look at your P&L by month, because there could be 2 insurance premiums that were paid in the prior month.
This is frustrating because, just to me, and I know how all entrepreneurs think, and this seems labor intensive. What's going on here?
Right.
They didn't pay they didn't do their job.
Yeah. And you have to look at the important things, like what's your biggest expense?
Debt ratio.
Labor.
Yeah. Well, in this business would be payroll, right?
Yeah.
Okay. So then you have taxes, and then you have wages, what you're paying out. These jive. Then you have QuickBook costs, bookkeeping costs, reimbursements. You have to pay some people back. They may have compensated them in their travels or whatever. Rent and lease, you're getting a smoking deal there. Taxes and licenses. Thank God the company pays for that for those people or whoever. The phone, again, that number's a little off again too. And is it better to look at these quarterly than monthly? Because this is an odd month. Maybe this hasn't balanced.
Well, so I like to look at it monthly.
So I would be circling these things. And so you spend, how much time do you think you spend going through this each month? Not because you're a bookkeeper. I mean, not because you're an accountant.
Maybe
because you're an entrepreneur.
Okay. But I spend more time looking at the health of a company. You know,
that's my favorite document.
Yeah. I want to know how many hours I worked in the company. I want to know how much I paid myself.
Did that ratio work?
I want to know how much we spent on labor.
Right. Those are my favorite numbers too.
You know, because those are ones that affect me personally.
Plus you could have a goal.
Yeah.
If I need to ramp this up or do this.
Or let's say we have a goal for, we have a very large expense in January, maybe. And maybe we need to
hold back.
Yeah. Hold back, take less draws, ramp up, be cautious with your expenses. So
you as an entrepreneur, these are decisions that you're constantly making. So this is why decision fatigue is for real, because you're rolling with this $50,000 to $60,000 carryover balance, but then you can't really grow with that number unless you're taking a huge risk.
Yeah.
In that individual's mind. It all makes sense. All right. So then you have a net income for July is what your net income is on the bottom. And then you have this ratio that corresponds. What is this year to date from reflective to any other year?
No. Again, these percentages are not jiving because I did a year to date one.
Okay.
But so one thing so your net income for a month, this essentially is reserves. It's your net profit for the business that you can either take for yourself
or pay tax on it.
And pay tax, or no. Take for you're still going to pay tax on this.
On this piece of paper, guys, it's $20,000 left over.
That $20,000 is going to add to your retained earnings.
That number, if I don't take it out of the bank.
Yeah.
So then that retained earnings on the first page, it says, is it 122?
So this is taking into account this 122. So this, because it's the year to date.
Okay. So it added that in there.
So our goal, I have a goal. One of our values with the company is educate not only our team members to be better, but also our clients too. We do outsource CFO work, but a lot of times I enjoy the education part better, because at the end of the day, it's your business and you are the one that has to make the decisions. But that's the reason for having our class, is just to educate.
And, how do people, there's some people that I'm working with right now, when I teach them how to raise money or I teach them how to ask for private money, they're dumbfounded. How did you learn this stuff? Just experience learning failures from other investors or other entrepreneurs, or your own experience as well? I think,
my own experiences working in different accounting departments and, moving into tax was a whole different world, because I started in accounting and there's many, many tax professionals that do not understand accounting. Would you believe that?
Yes. Because I don't understand it.
They know tax, but the inner workings of that is different. So, and then also, my own struggles as a business owner and an early business owner and dealing with inventory.
And I have no money.
I have no money, but I need to buy more inventory. And, it's just...
That's why I never got into retail.
It's tough. Inventory is tough.
Well, when I remember when you had that store, I was like, you're working 40 hours. Like, the door has to be open. If the door is not open, then you don't make a sale. You have this inventory that you pretty much paid, or you have a time bomb. It is a rough business.
And that's what led me to get into the online, even with the store. Okay, now we're going to sell online. So
yeah, interesting. Anyway, well, hopefully this was somewhat informed that you picked up one golden nugget. If you have not got a golden nugget out of it, don't worry, because October, that's right, 2 months from now, October 24th, we're having a class. Go to p3accounting.com. I will be there. There will be 2 super accountants there. So you get to meet Gloria Dale, who has a plethora of experience and entrepreneur endeavors. It's going to be a good time. p3accounting.com. What does it look for you, Rose? You're presenting at this class, and tell us, what's your goal for the class, or what do you want people to leave that space?
I want people to leave there with a little bit more confidence in their
belief in themselves,
in their financial statements, and not be overwhelmed when they get it from their accountant. Whether that be electronically or in the mail, or and pushing them to figure out, what are my KPIs? What do I want to study?
That'd be a good class. How to create KPIs. I think that I think my goal as a kind of a motivational kind of coach is to get them to look at them.
Yeah.
And hold their hand through that process, because I know from my own personal experience, I don't have time. I'm busy.
Yeah.
I'm tired. I don't understand.
A lot of times
I'm making money. I got to go make money.
A lot of times we start with people that don't even have financial statements, but yet they've been running their business for years. And, I look at that as running your business blind. That's checkbook accounting. So we have to get people to a place where, okay, you need financial statements. And I just ran into this with a client with a lot of assets. They did not have a balance sheet. And I told them that the IRS requires you to have a balance sheet
for a tax return
when you have over $250,000 worth of assets.
Yes, that's one thing. If you listen all the way to 51 minutes, if you have more than $250,000 in assets, you must have a balance sheet connected to your tax return.
And so that's reporting to the IRS what cash you have on hand, what assets you have on hand, your liabilities.
They want to know.
If those numbers are right, that's could be affecting your equity in the business and or your distributions.
Or your tax burden.
And at some point, that's going to catch up to you on paying more tax than you might have to.
Anyway, so way to end that deal. So if you have $250,000 more in assets, make sure you're having a proper balance sheet. Make sure you're using at least some software that's maintaining it for you, not just a spreadsheet. QuickBooks is a great tool online. Set it up. If you have any more questions, you go to p3accounting.com. You can reach out to us there. That's www.p3accounting.com. You can register for the class. October 24th, 6:30 to 8:30. Looking forward to meeting you there.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter at LandlordBook, and always be buying assets.